Hello friends, welcome to the December edition of Monthly Viewpoints. Market sentiment has improved recently as most of the news flow has been positive. In the US, we have seen that inflation has likely peaked out and is on a downtrend. Hence, the Fed has indicated that they will be going slow in terms of the rate hikes, even though rates may be higher for a longer period of time. The US economy continues to be strong, and recent data points such as the job growth, wage growth, as well as the services PMI numbers have come in above expectations. In Europe, we have seen that there has been a cooling down in the Russia-Ukraine conflict. Gas prices have come down, and hence Europe is in a relatively better position than last month. And as far as China is concerned, some of the COVID restrictions have been relaxed, and China is likely to go back on the recovery track. So going forward, from a global macro backdrop, there are four key parameters to consider. One is on growth. Given the aggressive rate hikes that have happened, US and Europe economies are expected to slow down and go into a recession next year. Although China is expected to recover, which will help some of the other Asian economies too. In that aspect, India is relatively better positioned given that we are a much more domestic demand driven economy, and we expect real GDP growth of 6% next year. The second parameter is inflation, which seems to have peaked and is on a downtrend. One of the key reasons is that commodity prices have come off as the global growth has slowed down. And hence, that leads us to the third parameter, which is the rate hikes. The Fed has already signaled going slow on rate hikes, and other central banks will follow them. Lastly, because of this, we are seeing a resurgence in FII flows to emerging markets, including India. In November, India got almost $5 billion of FII flows, which is almost 20% of the FII inflows that emerging markets got. So how does the picture look like from here? Clearly, India is in a good position. The economic data points are quite strong. The high frequency indicators for November showed that vehicle sales, energy demand, as well as airline travels have all picked up, whereas there has been some softer data in terms of the freight. Also, services PMI has picked up, whereas there has been some slowdown on the manufacturing side because of the global growth slowdown. However, on an overall basis, the economy seems to be doing quite well. That is also reflected in the Q2 earnings season, where we saw that the earnings growth was above expectations, and we have not seen any significant downgrades. As going forward, we expect an earnings CAGR of 13 to 15% for the next 3 years. Given that the valuations for India are above average and can compress going forward, we expect that the returns from the markets will be just below the earnings growth of 13 to 15%. We provide a basket of funds for you to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।